Hi there, you're still in my YouTube channel, Let's Talk Audit and Assurance, and currently you are in the Audit Snapshot dedicated to fraud, error, and non-compliance. Now, when we speak about fraud, error, and non-compliance, we have to call to mind the overall objective of an FS audit, and that is, of course, to express an opinion as to whether the financial statements are free from material misstatements. Now, when we talk about misstatements, we also recall that this can be sourced from either fraud, error, or non-compliance. Now, fraud and error is mainly differentiated by intent. To that we say if it is something done intentionally, then most definitely fraud. But if it is unintentional, then error. Now, it hypothetical or theoretically, it would be easy for us to draw out the difference between the two, but then in practice, it may not be as clear as day. Take, for example, the case of a double recording of a transaction. On the one hand, it could have simply been an error, maybe born out of a glitch in the system, but then it could have also been intentionally done and is ergo fraud, such as, for example, when they want to overstate certain accounts to meet a particular quota in order to come up with a bonus, for example. So again, it's quite easy for us to say intent, or whether it's intentional or not, that's the main difference. But at this point, especially in actual practice, the auditor must exercise professional skepticism, and of course professional judgment would come into play in order to draw out whether it actually is fraud or error. There can be telltale signs, of course, such as, for example, if it is error, then management should basically have no qualms about correcting the error because it's unintentional, right? In the case of fraud, this is normally accompanied by steps to ensure that the fraud is not so obvious, or covering up their tracks, for example. So that's fraud versus error. Now, in the case of non-compliance could actually be either intentional or unintentional and would refer to any instances where laws or regulations are not complied with. Now, the ultimate responsibility for the identification, prevention, and detection of fraud, error, and non-compliance, of course, rests with management and those charged with governance. In the case of the external FS auditor, the auditor's responsibility is to obtain reasonable assurance that the financial statements are free from material misstatements. And referring to this, these misstatements may either be due to fraud or error. So, while we cannot fault the auditor for preventing fraud, error, and non-compliance, definitely that is within management's turf. But in terms of the detection of material fraud, error, and non-compliance, it does fall within the ambit of the auditor's responsibility, as it is the auditor's responsibility to design the audit to provide reasonable assurance that the financial statements are free from material fraud, error, and non-compliance, which has a direct effect on the FS, but more of that in a few. Right? So, just to be clear, prevention, the auditor is totally not responsible for it. But in terms of detection, we can't totally wash off our hands, as we do have a responsibility to give that reasonable assurance. Now, speaking of fraud and error, there are two types of fraud regards the FS audit, and that could either be fraudulent financial reporting, you know this one better as window dressing, and misappropriation of assets. And this is what you normally imagine when we talk about fraud. This is where we talk about theft of assets or embezzlement of funds. In terms of the perpetrator, it could either be management fraud, and I think you have a very good idea of who has perpetrated the fraud in this case, or employee fraud. Now, generally, we would attribute fraudulent financial reporting to management fraud. Okay, would normally associate window dressing with management fraud because it is management who has the authority to make changes in the financial statements. Misappropriation of assets is normally attributed to employee fraud, but this does not mean that only employees can embezzle funds, because management can also do that. It's just that in the case of window dressing or fraud in financial reporting, not all employees have access to the financial statements or have the power or the authority to put in changes in the FS. That's why normally fraud in financial reporting is associated with management fraud. Misappropriation of assets associated with employee fraud, but may also be committed by management. Now, to this, we also recall the fraud triangle or the fraud risk factors. There is, of course, the pressure or the incentive to commit fraud. Think, for example, about quotas that need to be met in order to be attributed a bonus. Think about, for example, a possibility of being retrenched or laid off if not being able to meet a certain metrics. That's why it's very important for companies to come up with KPIs that are attainable. Otherwise, that if it's unduly, if it's unreasonable, it could very well yield to pressure to commit fraud. Okay, any instances, for example, of bonus or monetary incentives and such will of course serve to be represented by this particular fraud risk factor. And then there is of course the opportunity to commit fraud, generally related to a lack of or weak controls. And one of the inherent limitations of internal control is the possibility of collusion, and this also gives rise to the opportunity to commit fraud. Finally, there is attitude or rationalization, and this is how the fraudster sleeps soundly at night. When you, for example, hear comments like, well, everybody else is doing it, so why shouldn't I, right? Or, I deserve this. Or, I am being paid so low, the company wouldn't go bankrupt if I take a little bit of this or a little bit of that. Or, nobody has to know. These are attitudes or rationalizations, sometimes even going so far as to invoke the Robin Hood syndrome or the Robin Hood effect. I'm doing this for the greater good. So this would fall under attitude or rationalization. In the case of our risk-based audit approach regards fraud, error, and non-compliance, for risk assessment, which also includes risk identification and risk evaluation, of course, there will be brainstorming the performance of risk assessment procedures and the assessment of the risk of material misstatement due to fraud, particularly on revenue recognition, because we did mention before in one of our previous snapshots and discussions that there is a presumptive risk. There's a presumptive risk of material misstatement on revenue recognition. Now, we are not saying that this is always the case, but in instance where the auditor has decided there is no risk of material misstatement on revenue recognition, the auditor has to document and justify why this is believed to be so. Because as a rule of thumb, there is a risk of material misstatement on revenue recognition. On the risk response phase, of course, will be overall responses to fraud, such as, for example, heightened professional skepticism or even expanded testing. And as we have just said, expanded testing, the auditor may also perform intensive procedures for specific risks and consider the possibility of management override of controls. So here we get to see another one of the inherent limitations of internal controls, where we said management has the power and the authority to put the controls on pause. And once the controls are put in pause, then this opens the floodgates to possible misstatements to come in to the accounting system. So when there is a risk of material misstatement owing to fraud, then the auditor considers management override of controls. And eventually this will have an effect on your evaluation of the integrity of management. Now, in terms of conclusion and reporting, of course, we perform final analytical review procedures in order to determine if there are still unusual relationships that we get to observe even after the balances have been audited. We request from management written representation. So if you would recall, we do have general or specific written representations. We communicate to management and TCWG if there are instances of suspected or identified fraud. The general rule being that you report it to a level higher. So if you talk, for example, about minor fraud committed by low-level employees, this gets to be reported to the immediate higher level, like say senior management or middle management. But if it involves management, then this has to be reported to TCWG, and or if the company is an audit committee, then the audit committee. Okay, as what we have mentioned, if improper revenue recognition is not considered a risk, so if we have defied the presumptive risk on revenue recognition, then the auditor must justify and must document the reason. Right? So this is for fraud and error. Let's now talk about non-compliance. Non-compliance, these are acts contrary Okay, so non-compliance, instances where laws and regulations are not complied with. And this includes transactions by TCWG, or those charged with governance, management, or employees. But take note, this does not extend to the personal actions of employees. This will, however, include actions made by employees on behalf of the entity. So when we talk about laws and regulations, we know that the legal landscape of the business is so broad, and most of these laws actually cover operations rather than affecting the financial system of the client. Okay, but that is the reason why we do have to consider whether it has a direct effect or an indirect effect. So in the case of direct effect illegal acts, these are those which have an effect on the financial statements. Think about tax laws and regulations. Think about employee benefits or the pension law. In the case of indirect effect illegal acts, these are usually not reported in the financial statements but will eventually still affect management, usually in one way or another, but normally or usually in the case of operations. Like, for example, labor laws, health laws, environmental laws. Now, it's important for us to determine if the illegal act has a direct effect or an indirect effect because there is a difference in the responsibility of the auditor. In terms of the application of this in the risk-based audit approach, for risk assessment, we are required to obtain a general understanding of the legal regulatory framework as well as the compliance with the framework, understanding that it is actually management who is responsible to identify and evaluate instances of non-compliance. But as auditors, we have to obtain general understanding. We also identify and assess the risk of material misstatement. Now, in terms of risk response, if the illegal act has a direct effect, then the auditor is responsible to obtain sufficient and appropriate evidence. This would include, for example, reading documents, reading correspondences, inquiry of management, including the performance of substantive procedures. This is also one of the reasons why we do send a letter of confirmation to the client's legal counsel. So that's in case of direct effect illegal acts. But in the case of indirect effect illegal acts, since these are usually not reported in the FS, but I mean, come on, we know about penalties in case these laws are not complied with. So in case of indirect effect illegal acts, the responsibility of the auditor is limited to inquiry of management and inspection of documents. Okay, now in cases where there are identified or suspected non-compliance, the auditor must determine the nature of these instances of non-compliance or suspected non-compliance, discuss this with management, and evaluate the possible effects on the financial statements. Now, when the non-compliance happens with the blessing of management, the auditor must also re-evaluate the integrity of management. Now, in case of conclusion and reporting, similar to fraud and error, non-compliance is also part of management's written representation, and similar to fraud and error, if there are instances of identified or suspected non-compliance, they have to be reported to management and TCWG. The auditor will have to evaluate if this will have any effect on the opinion, and of course, documentation of the results and the findings is key. So there you have it, fraud, error, and non-compliance all are misstatements. And so therefore, if you talk about material fraud, error, and non-compliance, it is the responsibility of the auditor to provide reasonable assurance that the FS are free from material misstatements. So thank you so much for joining me in this very quick snapshot. If you have some MCQs you'd like to apply these concepts to, this will be the perfect time for you to do that.